Morning, everybody.
Good morning, sir. Good morning, sir.
You can hear me, right?
Yes.
Right. Okay. Sorry that there was a small technical glitch which took a bit of a time. Right. Now, let's start on our all right. We started on our credit analysis part last week. So let's start there. Okay. We were talking about different types of risks which you normally assess in a credit proposal. So the important risks are there are many others, but the important risks which we assess normally are the credit risk, interest rate risk, liquidity risk, transaction risk, compliance risk, strategic risk, and reputation risk. And then which is not confining to these, there are other areas also. Right. Now, this is basically, I told you, we are not looking at the customer side of it, we are looking at the bank side of it and then assessing the risks, right? So credit risk means is a counterparty risk. Normally in a lending proposal, your credit risk is the counterparty risk. Counterparty risk is what? You are giving a loan or advance to a party and that person is not paying it back, right? That is the risk. That's a counterparty. The customer is the counterparty. Counterparty is not paying it back. So that's a credit risk basically. So the major risk in lending is credit risk. Then the other thing is that interest rate risk. Interest rate risk is what? We give an interest to the customer and then most of the time we go and fix it. And due to the market interest rate changes, what happens is that it can be a risk to the bank. So this is what in fundraising we had been talking on this for at length. The thing is that the banks, predominantly the banks are operating with there is mismatch of funding gaps, funding in the sense we are basically except for the capital, except for the raising of funds through various instruments and all that, which you have kind of a 5-year horizon. Capital, of course, no problem. You have free capital means okay. Other than that, the deposits, most of the time what happens is that we are talking about majority of the deposits are 1-year horizon, but then you are doing lending 5-year, 7-year, 10-year, 20-year, like that. So unless your liability products are matched with that, you can't, it will be difficult for you to manage the interest rate risk. So the problem is that customers, when the interest rates are high, customers will maintain the deposit. They will not, withdraw. They will maintain that. Now, especially fixed deposits, 1 year back, if we had given the customer 12.5%, the customer will wait for the maturity. But the problem with the bank is that if you are lent at 14%, currently if you go and, the customer might come and ask for a early settlement. They will get a loan somewhere at 8.5% and then try to settle this particular loan. So the problem is that, maintaining a lending rate based on the deposit rate, it's a difficult task. So that's the interest rate risk in pricing. The market rate changes, variable interest rate, when it shifts, it's a difficult task. So we are trying to balance with various other ways. What are the other ways? We are trying to look at the cost of fund. We are totally how we are raising the deposits, not only from the fixed deposits, either CASA deposit. This is where the importance of CASA comes, because CASA you can reprice, savings accounts you can reprice, right? Not the fixed deposits. And if the CASA deposits are high, to a great extent, it will neutralize. So and then short-term borrowing from the market also at a lower rate. So that kind of things will, on an average, bring down the cost of fund, so that to match with the current lending rate. So like, I mean, if the customer is very demanding, we can't manage with him, he's going to repay the loan, he want to get a loan from elsewhere and then repay the loan. When that happens, if exceptionally we think that, I mean, we are going to give a loan, reprice the loan what we have given at 14% to 8% or 9%, this managing our cost of fund is very, very important. So that's about interest rate risk. Liquidity risk also that we were discussing in the past, where at the point of requirement of cash flow lending, non-availability of liquidity, right? The thing is, that is why the treasury, ALCO and all will have to work on looking at the funding gaps. Now, how much of deposits are going to be withdrawn next month? How much of deposits are going to be withdrawn over a period of next 3 months? How much will be withdrawn over a period of 1 year? For that, for withdrawals, how are we going to match? Now, how much of loans we are going to disperse? How we are going to arrange the funds? How are loans going to be repaid? And now the difference between amount of loans going to be dispersed, amount of loans going to be repaid, that difference has to be arranged, right, based on the period. So that's why always Treasury Department will have the gap analysis done. Like, I mean, during these 1 day, 1 month, 3 months, 6 months, 1 year, how the funding is arranged. Are we comfortable in meeting with the commitments? Are we comfortable in meeting with the customer withdrawals and loan disbursements? So that liquidity risk is there with the bank, which has to be effectively managed. Most of the time not by you all who are working in the front line, but by the treasury, right? So that's why treasury needs to know what's really happening in deposits, what's really happening in lending, and the pattern and everything. So they, at least on a monthly basis, they will be analyzing and then making the arrangement, but on a daily basis, they will be following up the position, right? Okay, so that's about the liquidity risk, right? So I told you many of the financial institutions, especially the finance companies, registered finance companies in Sri Lanka also, or world over, many financial institutions, they actually fail not because their assets are not sufficient to meet the liabilities, right? They will have a net worth. Their assets may be sufficient to pay the liabilities, but where the problem is that liquidity. When someone says that this bank has liquidity problem, and then someone goes and withdraws the money and then sends the message across, and if customers also like feel it, and then everybody flock at the counters to withdraw the money, that's where the problem, because we don't keep the entire customer's money in liquidity form. It is invested in various ways, invested in assets, invested in loans, advances, shares, securities, debentures, everywhere. We keep a percentage of the deposits with the in the walls as well as with the central bank. That is where your statutory reserve ratio, statutory liquidity ratio, comes to being. So reserve ratio, current scenario, about 4.5% is kept. Sorry, 2.5% is kept. Then liquidity ratio, you have 20% of your assets you need to keep in, 20% of your liabilities you need to keep with the central bank. We are not with the central bank, in a highly liquid assets you must keep, so that it can be turned to liquidity immediately. So now, if those measures are not properly maintained, and bank is not run in a more prudential way, then you face with the liquidity risk. So non-availability of liquidity at the time when it is required is a bigger concern for the financial institutions, which may pull into major problems like what I was describing. All right, then come the transaction risk. Transaction risk is what, while doing a transaction, whether we are making any errors, most of the time it human errors or systemic errors. This happens. Let us say while we are discussing a loan, a wrong account is credited, right? That is while inputting a wrong account number is inputted and then that not properly audited. Transaction error, right? It's a transaction error. This has resulted in the transaction risk. Say for example, you without taking mortgage, without executing the mortgage, the loan is disbursed. Once the loan is disbursed, let us say, it took some time to go and execute the mortgage bond. While you went to execute the mortgage bond, there were some problems that there was a caveat filed, or like something happened to the customer, or whatever. Then it's a risk. It's a transaction risk which has happened because we have disbursed the loan without taking the security documentation. By the time you went to execute the security document, you are faced with a situation where you are unable to execute the security mortgage bond due to various events taking place after the disbursement. Right? So various operational issues can come in there. I also described earlier a case where you go and lend to a company. A company you have lent, and the company is the managing director is giving his personal security, in the sense his residential property, to you as the security. So the lawyers have executed the mortgage. Now, when the loan is defaulted, you can't, the parata execution and all, we will look at it. The parata execution you can't do because it is not in the name of the borrower. It's kind of for the company, it's a third party. Even though it's the managing director's property, it's a third party. So you need to go to courts. So when you go to courts to sell the property, there the wife of the managing director comes and says, you can't sell the property because I'm a joint owner of the property. Then you go and check it what has really happened and see, yes, what she says is correct. The property is in the name of the husband and wife, but the bank's lawyers inadvertently has not taken the wife as the party to the mortgage. As a mortgagor, she has not signed, right? In that case, we call it the wife and the husband. The joint owners of the property are the mortgages. If both the mortgages don't sign the mortgage bond, then there is a flaw, there is a lapse. You can't go to courts and then auction the property, right? So in that case, the problem is what? It is the issue of the lawyers or panel lawyers who have executed the mortgage bond has not looked into these aspects, which has exposed the bank to such an amount of unsecured loan, which is bad now, right? You can't recover. So those are the types of kind of, transaction risk you will be faced with, operational risk, right? Then the compliance risk. The compliance risk also of late is becoming a significant issue because there are a lot of compliance requirements, right? Lots of compliance requirements. Central bank says if you have gone and opened an LC and then given an ideal import demand loan for a prohibited item, right? It's a compliance risk. It's a compliance risk. So we are faced with the penalty from the central bank. You can't do that. Why did you go and open an LC for an item like this? Right? So like what I was telling you, at various points there may be prohibited lending. Lending is prohibited, let us say, for someone who is involved in the drug peddling. Let us say you go and done a lending without properly evaluating. Customer has fooled you. He said he is going and setting up a farm or something like that. End of the day, he has not set up a farm or nothing. He just taken the loan, and the loan has been used for drug peddling, right? Buying and selling drugs. So it's illegal, right? It's a punishable offense, criminal offense. So let us say the law enforcement agencies look into that and then see that the customer has a loan taken from the bank and then that fund is used. They go and see that, who has given the loan and then which bank has given and then why they have given and all that. They look at it. Customer bank has lent without due diligence, without really looking at what the customer is doing, right? Whether the funds are applied to the purpose, those are not looked at. So bank will be liable for action by the law enforcement agencies. So that's about the compliance risk. Another thing what I was telling you all, say environmental authorities say so many things. To give a loan, you need to have the certificate from the environmental authority clearance needs to be there, right? That the particular factory, let us say we are lending, that factory doesn't, emissions from the factory doesn't, spoil the environment. Or the water which is released from the factory is not contaminating the surrounding area water bodies. So for that they will say that you need to cleanse the water and then release the water and all the conditions will be there. You put a risk, you put a what do you call it, a treatment plant, the emission treatment plant, right? So there may be a condition by the environmental authority to say that the factory can commence only subject to putting up a emission treatment plant, right? Water treatment plant. You have to put in then clean water without chemical only. You must release to the local water bodies. So let us say the customer has failed to put the treatment plant, water treatment plant, the customer has failed to put. Now, if there is a inspection done by on a complaint, if an inspection done by the environmental authority, they will find fault with the bank and say you have released a loan confirming that they have put a factory, but they haven't done it. So you are liable, right? You are liable for this offense of releasing contaminated water and affecting the people living around. So that is, those kind of things are compliance risk, right? Any questions here? Any questions from you all? Anything anybody did not understand? The ones especially who are not doing credit law, who are not exposed to these areas. If you have any question. Are you all okay? Right. All right. Now, we had been discussing this right along. Two major risks in lending are the inappropriate strategies used for loan growth. This most of the time you will find the the banks basically to a great extent are clear about this. The strategies for the long-term growth of the financial institution. What kind of strategies you have to follow in, the prudential measures and all that central bank also governs. Even the commercial banks are very careful about that. But when you find that finance companies, leasing companies and all that, sometimes they make a mistake purely due to inexperience. And then the drive to earn and show profit in the short term, they sometimes make mistakes, and that's one of the reasons why many of the finance companies having trouble, right, with their capital, with their running, and that ends up in closure of finance companies. Okay. The other one, what I was talking about, the strategic risk also. No, like one is a strategy what is being followed. The other thing is that the market segment also. If you take the commercial banks, including the state banks and then private commercial banks and everyone, the market segment to which these banks, these institutions cater to, may be slightly different from the market segment which is catered to by the finance companies and leasing companies. Why? Because finance companies and leasing companies sometimes take a higher risk because people who can go to a bank and get a lower rate, lower interest rate, facility faster, so then they are pushed to take risk with the customers who are like in the list of risky customers with the commercial banks. The sector which the commercial bank says that these are risky, and then we will go on a moderate basis, or we will not lend and all that. Eventually, the finance companies, become, they largely started operating with them. Now, not that I mean the premium sector is only catered to by the banks, that also catered to by the finance companies. But the thing is that many a time the other sectors are looked after by the finance companies because banks do not go sometimes not having that appetite to do that. For example, say three-wheeler lending, right? Lending for buying three-wheelers, two-wheelers, and all that. Many times the banks will think that there's a lot of work. You need to do a lot of work, and then recovery action, follow-up is very high. So it doesn't really make sense, and then risk is high. The banks may discourage, except for limited cases. But the finance companies may be doing that. And okay, the risk is diversified because the ticket per ticket item, per loan amount will be lower. But that's a riskier sector. Given the scenario currently under COVID situation, if you see when there is lockdown and then when there is very little operation, economic activity around, what will these three-wheel drivers and then small car owners will do? Taxis are not running. Can't run taxis. People are scared to get into the taxis. People are scared to get into the three-wheeler. Three-wheelers, almost they lost the business. So how will they pay the loan? Leave alone the loan. Their livelihood itself is in question. How will they pay the loan? They can't pay the loan. So those kind of issues, right? And on the other side, many of the financial institutes, including the finance companies, leasing companies, and all, they use outsourced collecting agent. That sometimes cost-wise that makes sense. For loan collection, loan recoveries, they use outsourced agent. And this outsourced agent sometimes does something which will harm the reputation of the institutions. Not every time, sometimes. Because their methods are like that. I mean, those sometimes can get criticized. So what happens is that when that kind of things are done, the name of the financial institution is kind of pulled in, and then there is a reputational risk, right? Okay. So currently, when you are assessing a proposal, the risk assessment is very important. It doesn't mean that we will identify a risk and then because it is risky, we will not go and lend it. The idea of risk assessment is different. The idea of risk assessment is that to see exhaustively look at all the risks which are involved in that particular lending proposal. So you identify the risk first. The risk you divide. What are the risks which can be hedged? Okay, like let us say you are looking at the security of a house, and then you look at if there is a fire, which is if the house is gutted down by the fire, what will happen? How do you hedge this risk? You ask for a fire insurance on the house, right? So what are the things which is to be hedged? Then what are the things which is to be avoided? The risk to be avoided. That is, let us say somebody is giving a property which is a joint family property which is given as mortgage, and then you go and see that for many years they are living together, 30-40 years as a joint family they are living in only in one son's name the property is, and then that is getting mortgaged. Now it may be a risky thing because people are living in that house for a very long period of time. In case of need, to evict them, right? Evict is putting them out of the house and then auctioning the property may be a difficult task. So how will you avoid? You will say, no, can you give an alternative security and not this housing property? Can you give an alternative security which gives the comfort to the bank that in case of need you can auction or liquidate the asset? So that is actually avoiding a risk, right? That's avoiding a risk. Now you find a particular customer is into various businesses and then borrowing from many banks, and then you find that he is actually over trading. He's actually over trading, and then he doesn't need more working capital than what he has already taken from other banks. You look at it, and then you say, sorry, at this point of time, we will not be able to consider a loan to you. What are you doing? What you are doing, you are avoiding the customer, right? You try to avoid. So that is one way, right? So number one, you are trying to, find a way of hedging. If something happens, what will happen? Now you see in a property, say the title is not clear. Title is only for 14 years it is clear. Customer, it's a valuable property. So for you to take the security, you might say that according to, because individual banks, every bank has their own policies on this. You may ask for a title insurance. To get a title insurance, if there is a problem, somebody else comes and claims the title or whatever, that the loan can be recovered from that, right? So you ask for a title insurance. What you are doing, you are hedging, right? You are hedging the risk. You are hedging the risk to somebody else, to the insurance company, so that in case of need, there will be a premium to be paid. That premium will be paid and deducted from the customer in many occasions. Then you are hedging that. Then you avoid. The other way of handling a risk is that you find ways and means of mitigating the risk, right? Mitigating the risk. So let's say that you're traveling, you're going by car, and somebody, before you approach a bridge, somebody says that's a rickety bridge, dangerous bridge. Please don't travel by that bridge. But there is an alternative way, right? So, I mean, you go, and then even though you find that, I mean, somebody else is using that route or whatever, you go by the advice and then take the alternative route. Why should I take that risk, right? You in your journey, you are mitigating the risk. Yeah, you are bringing down the risk. So that is mitigation. The third way is mitigation, reducing the risk, right? Reducing the risk. Okay, in a journey, you will have a risk anyway, but you are reducing that risk. So how in a lending proposal you will reduce the risk, right? So this is very much part of your proposal. When you're doing the proposal, you look at all these things. So like what I told you, most important thing is that you should be able to identify all the risks in all. Then you should be able to treat the risk the way you can, right? So different treatments only we were talking about, either to totally avoid the risk, either to hedge the risk and get some other protection, or else you mitigate the risk, right? So in the risk mitigation, when you're identifying the risks in a proposal, lending proposal, you have to come out with how you will mitigate the risk, how you will reduce the effect of the risk on your proposal. That's very important. So many a time in your proposal, you will know. Somebody comes and asks for a housing loan. You will say you put 25% equity. We will give you 75%, right? We don't jump and say, okay, lending proposal good, we can increase our loan portfolio. Somebody is asking for 100 million. You go and give 100 million. You will say that, I mean, how much is the house, right? Look at all the valuations and everything. And then you say, you put 25 first. Then we will give you 75%, right? That's equity contribution. Let us say you are lending against the share market. I mean, shares in the share market, quoted shares, public quoted shares. Against that you are lending. Now you see the market is basically very volatile, right? Share prices are going up and down. Some shares which are trading at 130 is going at 290, 390, like that. There's a big volatility. So there's a risk here, taking that as a security. Now you look at the past 6 months to 1 year, how the market has behaved, and then you say, okay, of the current valuation of the share portfolio what you have, customer may have shares of many companies, right? It may be banks, it may be diversified, it may be group of companies, insurance companies, it may be manufacturers, importers, anything. Now you look at that total portfolio and then you tell the customer, okay, we will lend up to 60% of the market value, current market value. If the current market value falls, of course, you may have to give more shares to secure that. So we will not go above 60% of the market value in our lending. So these are risk mitigation. You are trying to mitigate the risk, right? In case something happens, market goes down, customer is unable to pay the loan, and then we have to sell the shares and recover the loan. then we are having a leeway there. Even if the current market conditions go down by 40%, still we will be recovering the loan, right? Still we will be recovering the loan. So that's the mitigation, right? Mitigation. The other thing is that we sometimes go and say, okay, somebody has gone for a bigger investment. This investment is significant, and then it will take time to generate cash flows from that. Let's say somebody has put up a multi-purpose big building, factory and stores and everything kind of building they have put. So the for that particular facility which has been created from that, for them to generate additional revenue from that may take little time. So we put a condition. Okay, this investment is done until for the next couple of years, say for 2 years, you should not issue dividends, or you should not issue dividends without our permission, right? We will look at it whether you can declare dividends, right? We look at it. Otherwise, you are not going to declare dividends and pay dividends to the customers, shareholders, unless we are comfortable with that. But we have to be comfortable with is that the cash flow is enough to pay the loans taken, right? So no dividend clause, or partial dividend, or advising the financial institution that informing the financial institution that, I mean, okay, we hope to, we are going to issue 20% dividend to our shareholders. So you inform. Many forms by which you can put a control on the declaring and issuing of dividends to the shareholders. So that's one. The other one is pledge of equity. You pledge the equity, right? So take a mortgage of the shares, share mortgage, right? Equity portfolio, not the portfolio, I mean to say, equity of the company, shares of the company. You have take a mortgage over that, right? That means the customer cannot sell that. In worst case scenario, the bank can take ownership of the equity and sell it, right? So pledge of equity. Control on intercompany transactions. So one of the major issues in a conglomerate, one of the major issues in a group of companies, conglomerate I mean, is the group of companies. Where you will find a holding company, and then there may be many subsidiary companies, many associates and all that, right? In such a company, what happens is that many a time funds may be transferred. So holding company might take a loan. I mean, they have a good balance sheet and all that, and then they take a loan from the bank and go and pump into a subsidiary. That subsidiary is not doing well, right? Doing well, it's making losses. Maybe that may be a pet project of the chairman or managing director, and you go and fund the money into that, loans taken. So eventually it will be a problem, right? Eventually it will be a problem, because the loan taken not used for the purpose, it is used to fund some other business within, and that particular business is not generating income, and the company will find it difficult to service the loan, right? There are many issues like this. So we put a control on intercompany transactions. We say that, okay, the loan taken should be used for this particular purpose. There shouldn't be any intercompany lending without, without our approval, something like that. Fund lending from the holding company should be with our approval, so that we can keep a tab of what kind of capital amounts which have been transferred from one company to another. These are extreme situations, right? not in the normal thing. But intercompany transaction is a very weak point. Weak point in a group of companies. And then the other way of funding the intercompanies by a group is that amongst the companies, somebody will issue a debenture, somebody will issue a commercial paper, somebody will issue additional shares on that. The other company goes and buys. Either the holding company, which is the parent company, or at the end of the subsidiary in the group, they go and buy that. They go and invest in that. That means what? Funding intercompany. Yeah, in a different way, funding intercompany only. So that also we control, right? The other one here, what I mean to say is that interest on intercompany investments. Now, sometimes another way of doing that is that drastically lower rate they will lend to a group company. I mean, they would have taken at the market rate the loan, and then just to keep that company going, they will go and let us say they take a loan at 9% from your bank. They take a loan at 9% and then go and give that loan to subsidiary at 2%. Knowing that that company has a cash flow problem. So we borrow at 9% and give. Let them enjoy and pay only 2%. So these are all ways in which they can camouflage, right? They can camouflage the transactions. That you need to keep a tab on that. Some sort of a risk mitigation measures, some conditions and covenants we have to put. The other one is that operational maintenance agreements. Okay. We say that a particular lease you have taken, machinery or vehicle you have taken lease, you have given lease, and then you say that, I mean, for these, you need to periodically, you need to have agreement to periodically service it, right? Because that's an asset under lease to you, and you have a financial interest on that. So that you would like to ensure that it is up and running in current, and then with a very low wear and tear. So you say that, I mean, you need to, Industrial Development Board or somewhere, like somebody is maintaining that particular machinery, right? Somebody periodically on a monthly basis it is maintained. Those details are there. And when it comes to a vehicle, you say that, I mean, full insurance policy should be there. Why? Because we have financial interest on the vehicle. If something happens to the vehicle, that's a risk mitigation measure, right? So maintenance agreement, like operational maintenance agreement. Then there is other case, like, to mitigate the risk of our lending, sometimes we get the credit report from other financial institutes or other agencies, right? Like a CRIB report, what you are taking is like, looking at the customer profile. It's a risk mitigation measure, right? If the customer, in case have borrowed from elsewhere, if they haven't paid the loans on time, they are inconsistent, the borrowings are high, and if we are to lend, if we are not satisfied that, I mean, with the commitments what they already have, as we see from the CRIB report, they can't settle this, service this loan, we will not give, right? We will not give. So risk mitigation measure is that you take a report and see that first, and inquire from the customer where you have taken here and there. So you in your application you haven't said about this. So why you have taken, for what purpose you are taking, so how are you going to pay that loan and this loan and all that, you will check with that, with the support of that. The other one is credit report, right? On the buyers and sellers. Now, like, I mean, you're talking about import transaction, and the seller is in Germany, You have no way of going and checking him. There are companies like Dun and Bradstreet. The Dun and Bradstreet and all, what they do, they have a database of customers, and that is updated. Frequently it is updated. And when you ask for a reference from an agency like this, Dun and Bradstreet and all that, they normally will, on a fee based on a fee what we are supposed to pay, they give a report on the particular customer. Let us say some exporter from Germany. So they will give what publicly available, which is taken and collated, they'll give the information to us. That will show that, I mean, whether the company is has a reputation, whether it has a brand name, reputation in the market, whether you can rely on that, right? So that kind of indication you will get from the due diligence report on buyers or suppliers from this kind of international agencies. There is a thing called Sri Lanka Export Credit Insurance Corporation. It's called SLASIC. So what they do is that they give insurance or guarantees for the customers to go and borrow from financial institutes, right? So they facilitate now for let us say an exporter cinnamon. He is exporting cinnamon, but then banks are not giving any pre-shipment loan. The customer is new and all that, and so what happens is that they want a low-cost funding also for the exports. They don't want to go to money lender, other money lenders and all that. Then they go to the SLASIC and then tell that, and then get a guarantee from them, and then give to a bank. Based on the backed by the guarantee, bank will provide the required finance, right? SLASIC, and the SLASIC issues insurance and all that, arranges insurance. Export credit insurance from SLASIC can post-export or pre-export. So that also issued by the SLASIC. So, but I'm talking about this export credit insurance only. So for the export, facilitating export, somebody to go for a credit, they give an insurance. They give a guarantee for somebody to go and take a loan. So all these things are at some paper or other you will find as a risk mitigation measure in reducing the risk of your loan proposals. Any questions here? Anybody did not understand anything? Maybe many of you may not know these things. Anything you would like me to explain again? Yes? All understood? So if I ask you a question, what is SLASIC, you will answer, right? The other risk mitigation measures are, we ask independent evaluations. Even the lending officers, the branch managers, lending officers, assistant managers, relationship managers, who are supposed to have a judgment on the property valuation, right? Not only from the point of view of what the customer says, we get a independent valuer to go and value, right? That is done. Over and above, even in circumstances where branch managers or lending officers or RMs also asked to give their opinion in the proposal, whether this is acceptable, right? Because sometimes it may happen that when you go for an independent valuer, customer may sometimes influence the valuer. Ideal situation, undertaking, everything is that they should not do that. Customer should not do that, or valuer should not listen to the customer. That's the ideal situation. But in imperfect conditions like what we have, that is possible also. So valuer can connive with the customer and end up giving a high valuation for the property than what it is worth. So what happens is that all this will come up only at the time when we are trying to realize that. Only at the point where customer has defaulted, unable to recover from the customer, and we try to recover from the property. At that point only we will know that, whether it is overvalued. So the other day I was looking at a proposal which is basically funded for a what do you call it? The broiler chicken farm, right? Funded. Now, so they have put a lot of cages that and so many fixtures were there and all that. With that, the particular property was valued something like 120 million. And what happened when the customer has put everything, and then when he started the the chicken this one farm, what happened? There were problem with the locals. Locals objected to that, and then they objected that the industry should not be there and all that kind of issues. And somehow the customer could not continue his business there. So we had to now unable to pay the loans because the customer has done capital investments and all that, unable to recover, unable to do the business. So loan non-performing. Now we have to liquidate the assets to recover the loan. Now when we went to look at it, the customer has removed the cages and everything, and the property which was earlier valued at 120 million, current valuation given as 50 million. So current valuation is 50 million. Now if the current valuation is 50 million, forced sale value, you think if you go for an auction, how much we can get from that, you think? So these issues are there, right? These issues are there very much. So the independent valuation is a risk mitigation measure. So that's not only the valuer, the lending officer also is involved in giving a comment on the valuation. Sometimes we do, like with some customers, we come to an agreement with them to make a savings build-up. That is like from their monthly turnover, quarterly turnover, some amount you take and save it in a savings account over a period of time. So that can be used to liquidate some of the loans or part of the loans in future. So that's a forced saving, right? It's a forced saving from the income of the customer, building up balances for some time and using it up. So that's a risk mitigation measure, right? Then you find a lot of projects. Now let us say, for example, a construction company. A construction company like Maga, or like big construction company. they go and build up a bigger condominium property in collaboration with a company like HDFC, Housing Development Finance Corporation. They go and do that, let us say. Now let us say there is funds which are to go from both the parties, right? So for that, what you do, you have a common account that's called escrow account. Project funds. Both the project fund from it is put there, and then that is managed separately for the execution of the project. So there is escrow accounts you have, so that you don't mix that account with any other transaction of the customer. Say for foreign funding is coming, like a foreign company is sending money here and start a project. So when the funds are sent, and then that is kept in an escrow account until commencement of the business, commencement of the particular factory or whatever. So you keep that in an escrow account, and then for the projects exclusively use it. So those are escrow accounts, so that you ensure that it doesn't go. The funds are not used by the company or anybody outside the project requirement, right? Sometime back, I remember there was a large fund came from overseas to be invested into a plantation company, and that fund came in our bank, which was lying in a particular account, and the customer demanded, after some time, because the project is getting delayed, the customer demanded interest from the bank. They said, the funds are with you, so for a long time we are not able to make use of it. So you are supposed to pay interest on that, on fixed deposit rate. You pay the interest. That is a thumping amount which is coming, basically. So the bank challenged it. Why? Because that is an escrow account. The funds have come, and then even though funds are not used or the project got delayed, that they can't go and invest somewhere else and then generate an income. So the court upheld the bank's position. The court said, the funds which have come for a particular project is to be used for the project. You can't go and deposit elsewhere and then take interest, and then get a interest income from that, right? And so the case was basically case was filed not by the bank, by the customer. The customer was demanding interest, and then we said we can't pay the interest on this due to the nature of the particular account, and the customer went to courts, right? And the courts upheld the position, the bank's position, and then said that the bank is right. You can't go in. So those are escrow accounts, right? Okay. So that's a way of mitigating risk of losing the funds. Or losing the loan grantor. The other thing is the syndication arrangements. So a syndication arrangement is an arrangement by which many banks get together and fund a customer for a purpose, right? Now, that's what we call it, syndication. So there will be, for example, let us say John Keel's Holdings is putting up a big construction, waterfront properties, which they are constructing. It's huge. So their requirement is hundreds of billions. Their requirement is, right. Let us say it's a requirement is 50 billion. 50 billion rupees needed to complete the construction work. Now, one bank cannot go and give that. Somebody asked 50 billion rupees for a bigger development construction purpose, and then it's kind of iconic thing in the country. One bank cannot do. So what happens is that one particular bank who has the expertise will ask other banks, we are organizing a loan for 50 billion. Can you participate? And they will ask other banks, including state banks and private commercial bank, everybody. So that particular bank is called lead arranger, right? They are called lead arranger. So they are the people who are arranging. Then let us say People's Bank says, okay, we will give 5 billion. Bank of Ceylon says, okay, we'll give you 7 billion, right? And then Commercial Bank and HNB says, we'll give you 5 billion each, right? So like that, many banks get together and then give that 50 billion. So when you're doing a syndication, the lead arranger will arrange all the documents required and have the communication with all the financial institutions in arranging the particular loan and disbursement and control recovery. Also, loan recoveries also they will arrange it. They will have an account to which the fund to come, and then they will distribute among the banks. So for all these services, the lead arranger will have a higher fee income. They will have a fee charged to the customer in arranging and doing all these things. Right. So lead arranger, keep that in mind. Lead arranger is the bank which is arranging a syndication, calling for other people to come and syndicate or participate. And when it comes to security, let us say the waterfront properties, they say, okay, the land, the entire land, and then the building which is to come, you take mortgage. Now, if you take mortgage, who will be given priority, right? Who will be given priority? That matters. So is it like, the lead arranger takes the priority? But then the other banks will say, no, if you are taking priority, we are not going to participate. Because your loan portion is high, and then once your loan is paid only, they will pay us. Sometimes there may be, fund may not be enough to pay our loan in case of liquidation. So we can't go take a secondary, tertiary mortgage on that, right? So what happens is that there's something called pari passu security sharing arrangement, right? I don't know whether you can see the board. I will write there. Called pari passu. Pari passu security sharing arrangement. Called pari passu security sharing arrangement. So what happened? I told you. You have a lead arranger. You have a lead arranger, and then you have the participating banks. These are our participating banks. The participating banks, basically they like what I told you, 5 billion, 10 billion, like 8 billion, they will participate and then put it. And then when it comes to security parties handled by the lead arranger, right? They will arrange this mortgage under this concept, paripasu. That means, what do you mean by paripasu? Paripasu means equal rights. Right? Paripasu means equal rights. Equal rights in on the security. So it doesn't mean that the lead arranger will only have a priority or whatever. Every bank will have equal rights. That's called paripasu security sharing arrangement. Right? Any question here? Any question? So this is what I told you, is a risk sharing. So rather than one bank taking the risk, they are sharing amongst many banks, right? Risk sharing. So syndication, loans and sharing. So we will look at it later. Also, this is very important for you, the people who are in the lending, on the credit management. Syndication arrangement is very important concept. Okay. Independent evaluation, we looked at it. Insurance arrangements, also we looked at it. Various insurances there. Insurances are there. So on a house, on a property, you go for a fire insurance, right? On a machinery, you go for a machinery insurance. On a vehicle, you go for a full insurance. In the vehicle, you must understand there is, we call it comprehensive cover and third-party cover. So you all know the difference between this comprehensive cover, why you are asking for a vehicle's comprehensive cover? Yes? What is the disadvantage if a customer has taken third-party cover? Tell me. What is the disadvantage if the customer has taken a third-party cover? Yes?
If the vehicle met an accident and fully damaged, we can't recover the amount.
Yeah, if the vehicle met with an accident and okay, partially or fully this one, if you have a third-party cover, you can't recover. A third-party cover only guarantees the party who is affected by you. Right? You go and hit against a car, that car can be covered with the third-party cover, not your car. Right? So third-party insurance is just convincing the insurance requirement to put the vehicle on the road. But as far as the bank is concerned, you need to have a comprehensive insurance, right? If the comprehensive insurance cover is not there, the financial institution risk is high. All right. So we looked at a number of risk mitigation measures. Okay. Anything you didn't understand here in these risk mitigation measures? Any part you did not understand? So we talked about equity contribution, increasing share capital, and having a clause for no dividend or informing before declaring dividend, pledging the equity, controlling the intercompany transactions, interest on controlling interest on the intercompany investments, right? Insisting on operational and maintenance agreements, and having classic, guarantees or insurance from them, for pre-shipment loan and all that. So, customer reference, import-exporter reference from SLASIC can be places like Dun and Bradstreet international agencies, and having export credit insurance from SLASIC, right? Independent valuation, and then I mean the lending officer, manager, or RM doing the independent evaluation also. Having a forced savings by the customer from the monthly turnover, maintaining escrow accounts for project finance management, syndication arrangements. How do you share the risk by way of syndication arrangements, and insurance, different insurance arrangements. All these we have looked at. Insurance also, you know that your housing loan, there's a thing called decreasing term assurance policy also we take, right? Housing loan. What do you mean by the decreasing term assurance policy? What do you understand by that? Anyone knows about the decreasing term assurance policy? We call it DTAP, decreasing term assurance policy. Do you know what is a decreasing term assurance policy? Say you are giving a housing loan, right? You are giving a housing loan, 20 million housing loan. So if you are giving a 20 million housing loan, so year 1, end of year 2, year 3, year 4, year 5. So let us say you are giving for 5 years, right? So your capital outstanding here, end of year 1, you recover 16, maybe 12, 8, 4, 0. So if you are giving a housing loan for 20 million, and then let's say for 5 years you have given, for 5 years, end of every year, you will have end of first year 16 million, end of second year 12 million, 8 million, 4 million, like that, your capital outstanding will be there. So this may differ when you are going for equated monthly installment, the schedule will differ. For your convenience, I am mentioning the reduction balance method. Okay. So that means equally your amount will go down over a period of time. So this is how it is. Now what happens is that a housing loan, when somebody takes a housing loan, and then if they don't, something happens to them, either partially or fully paralyzed, handicapped, or met with an accident, and the customer passes away, some problem. If that happens, you have this policy. According to that policy, what happens is the insurance company gives an assurance that if during the year, up to the particular point, like up to the point of this incident taking place, if the loan installment had been paid, the capital outstanding as of that time will be paid by the insurance company. So they give a schedule also. If it is end of up to the end of first year, how much you will pay? In the second year, how much you will pay? By that time, they will give a schedule. So this is called decreasing term assurance policy. That is assuring the loan repayment in the sense, I mean, guaranteeing the loan repayment if the customer falls into trouble, unable to pay the loan, or customer passes away. This is because under normal circumstances, what will happen is that the bank will go and acquire the property, go for parate execution or legal thing, more like, I mean, acquire the property and then sell it. Now, in a housing loan, if you try to do that, what will happen? You're going to put the family out on the road, right? A family living, and then you're going to put them on the road to recover your housing loan. That is felt inhuman, right? Not socially responsible. So for that only, this what happens is that if something happens, you don't depend on the mortgage, but you try and recover from the insurance policy. That's called DTAP, decreasing term assurance policy. Any question? Right, that's about the insurance arrangements, risk mitigation measures. Okay. Now we look at briefly look at the valuations. Okay. Valuations. Normally we go for a look at a market value. Now anything we'll talk about a market value. A property market value means what do we mean by market value? We mean by market value that what is the value of this particular property or asset? What is the value of the property? If you can find a buyer, right, to buy, at what price the buyer can buy under normal circumstances, right? So that is the price market value of a particular property. The market value may differ time to time. The people who are paying municipal rates, you know that, I mean, what is the valuation municipal council places, and then what is the valuation we place on the property, right? And normally conservative municipal rates are lower, like, I mean, they place at a lower rate, and then based on that they ask the owners to pay municipal rates. When we look at a particular property in the market, it depends on the demand. What is the demand of the customer? So the more the demand, the higher the price. So while the other factors remain normal, value of an asset carries at such price, a buyer can be found to sell at such price from the market. Okay, so you can find a buyer to sell the particular asset at the market, right, at that particular rate. That's your market value. Now, forced sale value is slightly different from the market value. Forced sale value is that in a distressed situation, if you have to sell your property, you can't sell the property at the price at the prevailing market price, right? It will be lower. Normally this happens for us when you're going for auctioning a property. We won't get the market price, right? It is something like when you are working and asking for a job from somewhere else, what is the salary the company will be willing to give you? And then if you're jobless and then waiting, and then you go and desperately look for a job, then you ask for a job, then what is the salary you will get? Definitely in the second case, your demand will be lower because you are not currently employed, and there are so many other issues are there where the new employer will think and say that they will quote a lower rate only for you. Something like that, when the bank goes and auctions a property, it's a desperate measure in recovering the loan, and the market knows about it. And those guys who are coming and bidding for the particular property will always try to get the property at a considerable discount to the market. right, at a considerable discount to the market. That's what we call it forced sale value. Right? The price at which an asset can be sold under stressed conditions, which is less than favorable than under normal market conditions. You say under COVID situation, lockdown, people are finding it difficult. All that when you try to sell a property, you won't have many buyers to come and buy. So still, if you want to buy the sell the asset, you may have to go down on your price. Then people think that okay, at this point, if you buy, this will come up when the market is up, when the normalcy returns. You know, I will have a higher value appreciation, so I will go and buy. So discount to the market has to be given in such a scenario. So for the bank also it is the same thing. So bank also cannot demand the market price, right? Unless there is somebody who is very, very interested in that particular property, will buy at the market price. Or like, I mean, a couple of people are really, you know, fighting to get that particular asset. I mean, that kind of conditions doesn't prevail most of the time. Right? Okay, so that is forced sale value. So when you take a valuation report, normally we ask your panel lawyer, panel valuer, you will have a valuer in your panel, depending on the area. So the valuer will have to give a valuation report. We'll have to go and see the property and give a valuation report. So based on the valuation report and based on our own assessments, we will decide what is the amount to which we will take the mortgage over the property. So in the valuation normally, these are areas which will be mentioned in a valuation, like interaction and purpose, right? What is the purpose of the valuation report? The date of inspection, when it was inspected. What is the name and address of the mortgager, right? What is the location and situation? The right of way, accessibility right of way. In a property, a fixed property, a fixed asset, a housing or other commercial properties, the right of way is very important. Property will be in a very good area. For example, let us say that is in a very good area, and valuation is very attractive, let us say. But if you don't have right of way, say somebody is occupying the roadway, somebody has put up a building, or like, I mean, you know, in such a way that you can't take a bigger vehicle into that. Or it's only a like walking path only, you don't have, you know, motorable roads not there. I mean, if it is there, then there is very, very less value for that particular property. The right of way has to be there. It has to be mentioned, and then it has to be there. And we have come across many situations where somebody influential, somebody politician has put something before that, so that it's so difficult to pass that and go. Right? They have put some of their business or some of their building or something like that, free passage. Then there are other ways now, like, I mean, roads also, let us say, you know, you will have to go and then take a 90-degree and then go this side, and then, you know, you can't really go and take a vehicle turn and all that. Still problem, right? All that matters freely, so that when someone goes to inspect, we'll have to go and look at that. Its ability, right of way, how, whether there are any issues here, right? Whether any issue to be sorted out, all that must be mentioned. The plan, they will have to look at the plan. They will have to comment on whether the valuation of a property is based on the authenticity, whether legally it is approved, right? So whether there is a approved plan, approved building plan, right? Whether there is a certificate of conformity, we say COC, right? All that is important. If a building is put, what happens is that before putting the building, they get the plan approved, right? So that's a approved plan. Approved plan has to be there. After putting the building, again they'll have to go to UDA or municipal council. Again they'll have to go and get the COC, that is certificate of conformity. What does the certificate of conformity say is that the building is constructed according to the plan originally approved by the municipality or the UDA, right? So COC also is a must to consider a building for valuation. If you don't have COC, or if you find some construction, something constructed which is now normally COC will not be given for buildings which are not constructed according to the plan. Many times what happens is that Sri Lankan mentality is that they take a plan approved and come and construct 1, 2, 3 floors additional, or extend to the next man's boundary, or the slab will go to the next man's boundary, or some additional structures behind where you need to leave it, vacant. So something they will do to increase the square foot area, and when the when municipal officers come to do the inspection, they will find that this is not in conformity to the plan. Then they may say conditionally, you need to break all these things, then only we can give COC. So COC is very important, whether it is constructed according to the plan approved. So plan, the regulatory issues has to be mentioned in the valuation report. And the property should be described properly by the valuer. This is the description. This is the what is the property location is this, to the east, to the west, to the right, north to south, what properties are there. All that they will describe in the report. And then they will come to the basis of valuation. How they have, what is the basis on which they have valued. So they will say this is an old building. So the land in this area is commanding this particular per purchase. This is the value of the land here. So there is 10 purchase here according to the current market price. This is the value. But the building is constructed 15 years back, and then in view of that, per square feet value is attached this much. So they let to give the basis on which they are valuing the total property. They will say that for the building, so this is the value based on the area, and then land, this is the value, and then totally so much, and then they will have to give you the what is the market value, what is the for sale value, right? Those things has to be given by the, so then they will certify, give the summary and certify. Okay, in a valuation report, normally we will look at the property, whether it is the right property, right? Is the correct property, location, owners, detail, and everything. We will look at it, and then we'll go through all these documents, and then finally we will look at what is the valuation given, and we also will see that whether valuation is acceptable to the financial institution, to you, whether it is acceptable. So how you can do? You also can go and just check around, or somebody who is known, who is living there in this area, how much per purchase goes. So then you know that an old building is there, a 10-15-year-old building. Normally, a discounted value for per square feet is how much. You look at it, you will have your own valuation, and then see that whether that's justifiable. Okay, right. That's about the valuation of a property. The other valuation are also, now like I haven't mentioned here, there is this vehicle valuation. Second-hand vehicles are valued by some private accepted valuers, certified valuers available from them. The machinery and all are valued Sometimes industrial development board valuation is taken. If it is brand new, we have no problem. Invoice value we can take as a value. If it is second hand, then some valuation, some certified valuer will have to value. Machinery will have to be valued by somebody like industrial development board. And vehicle should be valued by the valuers. All right, that's about the valuation. Any question here? You have any question? Do you want a break? Do you need a break now?
Yes, sir.
Right, okay. So voice is good when you want a break. Otherwise you don't speak, no? Just...
Sir, sir?
Yeah, go ahead.
Sir, how many questions containing in this exam paper? Eight of...
You will be 20 mark questions will be there. So yes, you will be attempting, there will be 5 questions and then you will be attempting 3 questions. And then 140 mark question. So that means 3 plus 1, 4. 4 questions will be there. There will be subsections. Right?
Okay.
We will look at questions. We will discuss some question papers. Once we finish this theory areas, we will work with some question papers. All right, have a break. Come back 10:50. We'll meet up at 10:50.
Hello, sir.
Yes.
This is regarding the assignment.
Yeah.
You have been mentioned in that assignment that it needs to be restricted to maximum 1,700 words.
1,500 words, which is the core part of the contents. I mean, you don't take into account all the other things. I mean, title, what you put, the agenda. I mean, the introduction part where you put the contents and all that. I mean, those you can avoid, and then the core part of the write-up should be 1,500, and then there can be little tolerance. Like it cannot be like, I mean, you know, more than 200 words.
Okay, sir, clear.
Right? Okay. So have a break and come at 10:50. I hope you all are ready with your assignments. Today 10th, I think by 15th is the timeline for you. Submit it.
So after 15th, they won't accept the assignment.
I had been telling from first of probably from the beginning of I mean from November or something. I am telling you. I think November or December, early December. So I mean, doing a 1,500 assignment should not be an issue for you. But what happens is that when we are delaying this, you know, marking papers and giving marks and all that takes time. So because then they are after exam, and you will have to do the exam, and then the exam paper corrected, and then if you are keep on sending this particular assignment, releasing the marks becomes an issue, because this, I hope, is probably one of the last subjects in your course. So that has to be done faster. Right? You know, I can give a little bit of tolerance, but then it's not kind of, you know, openly you can keep on extending or whatever. So for very valid reasons, slightly delayed and all that, we can take it. Otherwise, 15th.
Okay, sir. Thank you.
All right. Okay. Have a break and come back. Are we ready?
Yes, sir.
Okay. All right. So let's look at the issues when you are looking at a proposal. From a personal customer, what are the things you will encounter? Say from a branch, Colombo suburban branch, you are working and then you are looking at a customer. So for a personal loan, or like a corporate loan where somebody is involved, managing director or somebody is a private limited liability company, a person, what are the things you will look at? You will have to look at what is his education, his background, right? Where he's coming from, where educated, right? What is the family status and residence, whether he's married or single, or like, I mean, family, dependents, all that, whether he's resident of Sri Lanka or like, I mean, he's working somewhere and then, you know, visiting the country, and what is the future potential, where this particular company, this particular individual is going, right? What is their future potential if they're in the job? What is the potential for him in the job? And current income, what is the type of work he's doing, right? What is the place of work? Where is he working? What's the type of lifestyle? Yes. When you're looking at the lifestyle, say, many a time when you are giving a debit card, you are able to see where they are spending the money, right? So whether somebody is really living beyond their means, that's one of the problems where people live beyond the means, and so that they eternally, you know, live on kind of credits and borrowed funds. So their lifestyle matters. Sometimes somebody who is having 150 to 200,000 salary, spending on 5-star hotels and then going for clubbing and all that, which doesn't really suit, right? It doesn't really suit. So lifestyle. When you're looking at the place of work and type of work also now, like, I mean, for example, if it is IT, people who are working in the IT field, they'll be very, the turnover will be very high. They're sticking to a particular company, the time period will be very much limited compared to some of the people who are working, let us say, for companies like John Keel's or like, I mean, kind of, Haley's or whatever traditional type of, work environments and all that. It may be different from a, purely IT, a guy working in IT firm. So I have come across some companies which are actually international, but the employees join for a small salary difference or some other reasons that they can't work in the night. They want to find a day job or whatever. They leave and go elsewhere. They will work again. They will come back to that particular company again. They will work and go. Now these companies are also, these IT companies and all, they don't have a kind of a expectation that somebody should work for long, and somebody who has left the company and gone, we will not re-recruit, right? I mean, even our bank and all, we have that kind of a thing. We don't, we will not go and re-recruit people who have already left. If they come and offer their services again. So it differs from work to work, industry to industry, company to company. It differs. So these things you will have to analyze for you to sort of analyze a proposal whether this can be given. So when it comes to corporate customer, a company, normally few things. What we are supposed to look at is that we will have to look at the business, whether it's a legitimate business that the company is involved in. What is the business model, right? What is the environment and competition, right? What is the, so now, like, I mean, whether there is any chance that this particular company can run out of competition, right? For example, let us say there's somebody who is dealing with Nokia phones. Market is not there, right? A deal of Nokia phones, market is not there. You can't expect, right? So the people are really moved into all smartphones of there are cheaper varieties coming from China, and then people who are looking for brand will go for Apple, and then somewhere in the middle, Samsung. Like you know, so it depends on the what is the environment in which the customer, the corporate works, and then what is the competition, right? What is the technology used, right? Whether it is latest, up to date, or like, I mean, it's kind of a olden day thing they have, right? So that also, has a say on particular business and its continuity and its competitiveness, right? Technology and operations, how they are evolving with time, or are they still the traditional type of having manual works and manual employees who are doing all that, so the cost is high and all that. So that part. In the financial condition, that of course you do a financial analysis and you will find out. So what is the net asset? How is the capital? Where and where they have invested? How leveraged they are? How much they have borrowed? Right? Like, I mean, how much they are running with their own capital? So those things you will look at. How much they have gone and put into the stocks, right? Or financial conditions, whether liquidity positions. One other thing is the culture. Every company, every corporate has their own culture. Like we have different ethnic groups, different country groups have different culture. So we have different ways. I mean, how we will celebrate our festivals, when we will go to the temple, and then how the children at different stages they will be treated. When the girls, when they grow up, people, different ethnic groups have different ways of doing that kind of. I mean, that's culture, right? Culture like that. The companies also, they over a period of time they develop a culture. So the culture, where it matters to us is that how they take the decisions, who calls the shots in the organization, how the investment decisions are taken, right? How the business expansion, where to reduce or where to increase, and all. Who there may be, it may not be sometimes the managing director or people on the top. There may be some influential guys down the line who will be really, feeding that and then influencing the top. The culture is like that. I mean, so it differs. Even amongst the banks in the country, if you see, different banks have different culture. The People's Bank, Bank of Ceylon, HNB, Commercial Bank, Sampath Bank. If you really walk into that and then see what is the culture is different, right? Culture is different. As a whole, our objective is the same. As a whole, our business model is the same, but the culture will be different, right? So understanding the culture gives insight into the business model of the particular corporate. Okay, and then there is sector, industry specific issues are there. In what industry they are working, right? What sector they are working. So specific areas. Now let us say that there are construction companies. These construction companies are basically they're doing roadways. Okay, so they are doing working with what do you call it? The Ministry of Roadways, Ministry of Finance. They'll be working with them in sort of completing their projects. So what are the issues there? Now, if you look at somebody comes in and says that we are constructing, we are bidding and constructing roads, public roads, the government projects. There are so many internal issues are there. Look at it now, like, I mean, how the contract is awarded, what is the basis, and now what are the conditions. Once the project is completed, how long it will take for the release of the funds, right? What to do with the additional time taken for the release of the funds and all that. How do we manage? So many issues are there in the sector if you are looking at it. So like that, I mean, consumer goods, different. Pharmaceuticals, different, right? The supermarkets, right? Different supermarkets. There are lots of supermarket chains. How do they operate? What is the market condition? Now, if somebody or supermarket comes and says that, I mean, for procuring items for, I mean, we want 3 months working capital facility, so give us 500 million, you will think, I mean, okay, these guys are selling on cash. Predominantly, they are selling on cash. Why are they coming and asking, working capital facility, for a longer period? Because you guys are, buying from the market and then selling, and then you are, I mean, in instant cash, you are not giving any credit period. So things like that. Geographical, political issues also for a corporate, how it affects, we must know, right? Political issues are there. Now, like somebody who is a telecom operator, TRC rules, Telecom Regulatory Authority, the TRC rules matters, and then taxes on the call charges, how that is imposed, that can change the business model, right? So the political issues which are faced, somebody is putting up a huge property. So what kind of political sentiments are there on that? Whether that has a support of the government. So, like, I mean, whether there's an issue with the government. Those are important. Geographical, right? Where it is having the custom. Like for example, let us say somebody is exporting ready-made garments, where they are situated, and then how they are kind of supply chain works when they are exporting, whether they are close to the highways and then ports authority and all that. I mean, access to ports authority and all that. Those going to be high. What can I say? The overheads are going to be high, right? So those issues you will have to look at from a corporate customer. So while you are looking at a customer, maybe it is a personal customer asking for a personal loan, consumer loan, housing loan, right? Any type of this one, any type of loans which are required for personal, or else for a company, right? For various purposes. When you come to non-personal company, they will ask for various purposes. Business working capital, for import line facilities, export line facilities, pre-shipment loans, kind of term loans to buy a property, to put up a factory, to expand the current businesses. So there may be so many reasons for which a firm, a non-personal account, a corporate can come and ask for a loan. So when that happens, you as a lending officer, lending is I can say, taking decision on lending is sort of science as well as art, right? Science because it is evolving, art because you become You become an expert by way of experience, right? So you apply your own experience. So as we grow old, as we grow up as a lending officer, we gather a lot of knowledge, right? We gather a lot of knowledge. So when we look at a customer, we will be reminded of a customer of the same stature, how they will be behaving, what is the industry pitfalls, what are the challenges in this particular industry, how this particular customer is tackling that. All that will come to your mind. That's experience, basically. That's your experience. And somebody comes from IT company and then says that, okay, I'm going to work for this company for 10 years. I want a housing loan for this much, and given all that, you will think twice to say, okay, will this fellow last year, right? Okay, how long this fellow year? What is our experience, these IT executives? Is it okay? All that you will come to your mind. It's not that to say that IT executives are bad, but then what I said was there is a quality that they may be changing their job faster. Sometimes they will go on their own. All that is there. So those has to be taken into account, right? It has to be taken into account. So, so applying your own experience, your past experience. Sometimes when you are talking to your boss, your colleagues, you get experience from that. That also is important. And interviews and discussions. Now, while you are engaging with the customer, you should be intelligent enough to ask questions which really brings out the required information from the customer. Just casually talking about, when they come and ask for a facility, you talk, and then thereafter you talk about the politics, and then why that, this politician doing that and this and all that, and then okay, let's look at it. And if you send, you are not a good lending officer. While you are discussing with the customer, you should be able to really put the, questions in such a way so that you get maximum answers from him, so that your knowledge about the customer increases, especially where it matters. What is the business they are doing? What is the business model they are having? How they are currently financing? What are the markets they are selling? To whom they are selling? Whether people to whom they are selling is dependable. Whether what is the kind of age analysis they have? What is the kind of credit period they give? Right. So all these different ways of asking questions should bring in, so that you will jot it down while you are interviewing and then discussing. You will jot it down for you to prepare the proposal, and then you will do the customer visits, inspecting the customer's assets. In customer visits, very enlightening and eye-opening experience where a lot of things can be said in the paper. A lot of rosy picture can be painted on the paper. But seeing is believing. We call it seeing is believing. When you go and see a particular property, the running business, how they are doing, how they are dealing with the customer, what is the place, what is the location, what type of customers are visiting, what type of suppliers who are visiting, how the how professionally the employees are behaving, how the stocks are maintained, how the office is maintained, right? Many things you can go and see when you are visiting a customer, right? It can be totally different. Some time back, I was watching a documentary where this is a kind of an investigative story where in US, some companies, somewhere around 2000 and after the financial meltdown, in 2012-13 period of time, some local companies in US, they were promoting some Chinese companies and then telling that they are the next wonder, and then we must take part of it and all that in those companies to invest. They were the American investors. So how they are doing that is that the Chinese companies, those are being kind of merged, kind of what do you call it? joint venture type of company they establish with them, with a defunct US company, the listed defunct company, which is not really functioning in the market. And then say that this company has kind of had a partnership with these joint venture with this Chinese company. Chinese company is doing these things in printing areas, this thing, oil, grilling, coal mining, and then kind of different industry. Talking about that, and then those companies from China, they say they are coming and having joint venture and listing in stock market in US. And when I was watching this, they were talking about the valuation of the shares were going, and the local promoters were promoting that shares, telling that they are big companies making huge profits and all that kind of thing. Some investigative journalists thought that they will, looks like it's too good to be true, they will visit China. Without telling the reason or whatever, they will visit China and visit those places and see. So when they visited China and then went around the factories, what was mentioned, and then the locations what was mentioned and all that, it's totally different story. Those are all made up. Actually, there are no such businesses and all that. Now, these are some Chinese businessmen. They got along with American some people, and then again cheated the American public also, telling that well-to-do companies are really coming up. These Chinese market is booming and all that kind of thing. Those stocks are sort of listed. And the people going and buying that, want to take chance, want to buy these shares before it is too late, so that we can get the benefits and all that. Finally, after finding out of these particular journalists and then other investors in the market, they found that actually the market lost about $35 to $40 billion in these false companies. Like that in Sri Lanka also, if you see, there are many people who try to do this. Like, actually they don't have that kind of a business or turnover or customers or nothing, but they just make it up. In my early days, somewhere in Old Street, Kotehina, I have seen sometimes the borrowers go and show the warehouse of somebody else. It's not theirs. They get the permission of somebody from earlier, and then they go and show that is where our warehouse, and these are our stocks and all that kind of things. So when you try to check that up independently, you find out, these guys are trying to fox us, right, to get a loan. So everywhere you find this kind of so customer visits and inspection is very, very important. The other thing only which is you are concerned about is that analyzing historical data. So you what analyze? What are the things you look at? What is your conclusion? Right? That's about that we will look at financial analysis. How do you do? Right? So now, industry norms is important for a business. If you are looking at, let us say, supermarket business, and then you are looking at funding a particular supermarket, you look at it, and then they will say, what is the profit margin? If somebody says, I have a 20% profit margin, so it can't be. Others are having, the market norm is what? Market norm is about 9 to 10%. For example, I'm just telling 9 to 10%. They can't keep, because these are things which turn over very fast, which are sold for cash and with a smaller profitability. So they can't have a very high margin here. So 20% margin is too good to be true, but the market norm is what? So you should know the industry norm. What is the market norm? That's very important. Now, if it comes to a steel factory, let us say, steel trader, steel trader actually will need a longer period of working capital. And then their margin may be very high because they give a they import and then give a long credit period, right? So they are, margin maybe so that industry norm. So you need to know which industry, how it operates, what type of a margin they get, and all that information will give you the strength to go and look at a particular customer's operation and say whether this is right or wrong. So for example, like what I told you, you will have your reservation to go and fund a supermarket chain when they are coming out with that kind of fantastic figures, or asking for a longer working capital facility and all, right? So now, if you go for, say, construction business and all that, you should know that, I mean, construction business, how long it takes. Somebody putting up a condominium property. Condominium property, basically, to put up, what happens is, what is the way they are doing. So a developer will go and negotiate with a landowner and take the land, right? So there will be a joint venture between the landowner and the developer. Developer will put up the units, and developer will start generating funds from the investors, prospective investors who are booking the housing units, apartments from the particular thing. So from when this money will start coming in, right? How much this guy has to invest initially to put up, and then start, and then as they construct and go up, how much money they can generate from the prospective people who are going to invest there. So how they will finance. This information you should have. If somebody says that, okay, I'm going to put up this one for me to purchase a land, it will cost about 100 million. For me to put up the total housing units, it might cost about 1.5 billion. So I want 1.6 billion facility. That means I will put about 200 million equity. Well, give me 1.4 billion facility. They ask, I mean, you should know that that is not the model it works. So you will ask questions on who is going to put the land, whose land is that, what is the arrangement? Are you going to buy outright, or are you going to have that agreement and then they will take part of it? And how much you will put and construct, at what point your contribution from these people who are investing in this apartment will come in. All that we'll ask, right? Then you will come to know that they actually don't need that 1.6 billion or 1.4 billion. For them, about maximum about 500 million is enough. Balance they will generate. They will generate from the prospective investors. So that idea you should have, right? Industry norm, what is the industry norm? So different industries have different ways of operating. If you know the industry norm only, you will be able to deal with that particular customer. Otherwise, people will take you for granted. They can cheat. And then how the customers are spread, what area customers are spread, which is like what is the geographical area, what the country, I mean, if they're exporting and all that. Now, like for example, a tea exporter, let's say the US having issues with the Iranian government, and then they are looking at putting sanctions and all that on Iranian government, and then let us say Sri Lankans, we are exporting a lot of tea to Iran. So let's say we are funding a customer. This customer is 95% exporting to Iran, let us say. There's a risk, right? There's a risk. So you are exporting to Iran and you are expecting us to fund, but Iran has these problems. If there is sanctions coming by the US, and then if they are blocking financial transactions and all that, we won't be able to get the export proceeds. So how are we going to handle it? That's important. If we just because somebody shows all the figures, if we go and fund it, will get caught, right? And you know, a lot of reading need to be on business. Somebody who is a lending officer who is convinced of lending to a customer and then preparing a proposal, they need to read a lot of literature on the particular business. So how the business started, what is the business model, how, you know, currently what they are doing, what are the product range with it, how they have improved, and all that. I mean, you need to understand about that. And how is their presence, whether it is local, whether it is national, whether it is international, where and which countries they are present, right? That gives a lot of idea. The other day I was talking to a consultant. This consultant, it was interesting. This guy was telling he was doing consulting to you know, the construction, road constructions and all those. He was doing consultations. So somehow he was working with some international consultants, so that he got the flavor about you know, how to do the how the international consultants work. And then he was trying to, you know, on his own try to get some contracts here. He got it, but then with a lot of difficulty and all that. And at the same time, he got an opportunity to go and do an international one particular consultancy service. When he went and did it, the company with which he did it were looking at selling that company, and then they were not doing well, and then they were. So that company is having branches in UK and then another 14 other countries they were having. So this customer somehow grown to that extent of going and acquiring that company. So I was happy to see that a Sri Lankan company, Sri Lankan consultant is able to go and do that way and then acquire. And then, I mean, his operations are there in about 40 odd countries. So their presence, so that shows a lot about their kind of you know, how good in their job, and then how they are performing locally as well as how they are able to internationally you know, compete, right? If you look at Dilma Tea, how they are internationally competing, it really speaks about their business a lot, because you know, locally sort of doing something is different, and internationally competing with other countries and then establishing the brand is a big thing, right? I mean, we don't have many businesses in Sri Lanka in doing that. Dilma is one of that, right? They have very successfully established in Australia first, and then in other countries thereafter, and then with all the airlines and all that. I mean, you know, Dilma is a top of the mind name when it comes to tea. So innovating, you know, coming out with various products and then very colorful packaging and all that kind of thing. I mean, they do really a good job as a company which has an international presence and very successful at that too. And so these you know, you need to understand those things. Okay. So I'm not scaring you. I'm not. I don't want to scare you of that. I mean, you know, a lot of things are needed and all that kind of. But this is how a lending officer develops, right? Lending officer, these are how he develops. With this knowledge only, he can shine as a good lending officer and come up in the career. Any questions? Half of the problems what we have, I'm not talking about the COVID-19 related, you know, loan issues what we have. COVID-19 issues are completely different, because I mean, that really, I mean, the things which went with the customers are beyond their control, right? When the market lockdown, you know, locally and globally, the issues coming from this particular lockdown issues actually affected a lot of businesses. But otherwise, half the problems come from our wrong structuring. Right? many a time what happens is that we play into the hands of the customer comes, and then he is let's say running a business, and then influential guy and all that. He says that, I mean, give me 100 million overdraft, right? I have the workflow to pay this. Give me 100 million work. So, I mean, we go and give, let us say that, I mean, okay, we look at the customer profile is good and all that, without going much into that, and then we go and give 100 million. Now, how do we structure a facility? Is very important. If we just simply give 100 million to a customer for he just says that, I mean, for my business or whatever, and then he goes and invests in share market, and then share market goes down, for example, share market goes down, that turnover is not coming. What happens is that here, even the existing businesses will be blocked because of this, because there's a commitment, and customer is not generating any work, cash flow from that, and that commitment we are running behind. And then if we don't pay the checks of the customer, then his regular business will be affected. So by a wrong lending, what we do is that we go and put a block to the regular business. Many times this happens. In NPO also, if you go and see that, many times wrong structuring is the reason. That's why we look at, I mean, if you are giving a overdraft, for example, I'll give you this example for you. Just look at the board. So you are giving an overdraft. Okay, your overdraft is like, okay, 50 million overdraft you are giving. Right? 50 million you are giving overdraft. So let's put January, February, March, April, December, like that. So you are giving the customer's balance is here, and you are giving an overdraft for 50 million. He uses it, and let's say, and money comes, credited, uses it, working capital comes. If it goes like this is the overdraft, use of overdraft. I mean, proper use of overdraft. Your overdraft normally, working capital facility. He says that, I mean, I want my credit period given to the customer is 1 month, so that, I mean, every month I will get the money back, so that you give. So overdraft is used that way. It comes to credit. I mean, even they will go up to 50 million credit. Now, what happens many a time, in your customer base, you will see the overdraft normally, in reality, this happens. Okay, customer was here, we gave the overdraft, he used it. All right, first month, okay. All right, this is come this way. And then second month, okay, using the overdraft. And comes here. And again. Yeah. Again. It is like that here now. All right. This usage. Actually, this happens. What happens is that customer is not settling the overdraft fully. He is operating at that level, right? He is operating at that level, and it goes below that also, right? And at a certain point of time, it becomes this position we call it hardcore. This is hardcore. This is hardcore because it's stagnant. Here some fluctuation was there initially, and then after about 2-3 months time, it became hardcore. Why? Because customers diverted the funds elsewhere, right? It's not really working as a working capital. It can go up to 50 million. We also allow that. Okay. So many a time in your I think if you see book, you will find this particular issue where overdraft will not be fully settled. It will just be at the particular limit. It will be operating, and then hardcore formation. And then at that point of time, what we will do, we will try to go and restructure that, give a term loan, observe that. So wrong structuring. Now let us say for composite facilities, for a customer, we are giving a kind of a number of facilities. Say for working capital facilities, overdraft we are giving, and for putting up a factory, let us say we are giving a term, and for other setting up of office or something like that, we give a term loan. For import loans, we are giving a LC limit, and then import demand loan like that. I mean, we give a whole set of facilities. Now all these facilities need to be like if you are giving an import line facility LC, it has to be how much a customer, what is the turnover, how long it takes once you open LC, or once you give an order, how long it takes for the shipment to arrive, how long it takes for them to turn it over, sell it, and get the money. So based on that only, you must go and set, fix the limits. If you set a limit which is not in conformity to the business operation, not in line with the business cycle of the operation, then you are asking for trouble. Yeah, then this kind of a problem will come up, and then we are wrongly structured, and the customer has taken money and then transferred money elsewhere or some other place, and then now this will happen under this current moratorium very much, right? Moratorium because of the government directives also. I mean, we have given the moratorium to a lot of customers, where customers there are customers who have the cash flow. Not that everybody out of this lot is unable to pay, and then they need 6 months to 1 year time to settle or whatever. There are customers who can pay, but then they think that okay, at a lower rate, capital need not be paid, or capital interest also need not be paid. So why should I pay the bank? That's my right, and they divert their cash flow elsewhere, right? They go and invest in things, and all that kind of things are happening, which we can see, which is dangerous, right? So that is, not in line with the customers, cash flow. So leave alone these COVID-19 related moratoriums and all that. Those are things we will have to somehow live with that, and then get over this, and then we will see the real problems after this moratorium period is over. That's a different issue. But under normal circumstances, structuring, if you make a mistake, that only most of the time, in my experience, we come across bad loans, non-performing advances. The headaches down the line for us to handle is happen from the beginning, where the structuring is long. Many times we go and do the name lending also, due to the reason that particular person is well known in the market. He's a politician. He is a very influential guy. Kind of a name lending to a great extent, which that company that cannot go wrong. And then we don't really look at the purpose. We don't really look at the purpose requirement, tenor, and all that. The moment it is asked, it is given. And you know, everyone has their own cycles. Now, when businesses are suffering, they are going through a bad patch. Bank can, you know, safeguard themselves only by way of, you know, doing those things prudently. If we haven't done that, if we just went with the flow that customer is doing really well, actually very good, anything we can do, we don't need to do evaluation, and then when you go and give, and when the customer is unable to settle, all this will be exposed. And that's happening in the market very much, right? Wrong structuring. Inadequate, excessive limits. You know, we don't look at the limits for what is required now. But the thing what we should keep in mind is that we should not lend to a customer more than what he requires. More than what he requires. When you go and lend, he will have ideas to go and spend elsewhere, right? Unproductive, less productive areas he will go and spend, right? Then he will struggle to repay. Lower limit if you give also problem. If you set exact requirement is 100 million, and then but then you say that no, we can give you only 50 million, balance 50 million you look after elsewhere. If you do that, what will happen is that, okay, from the bank he was able to get only 50 million. Then for the next 50 million, let us say that's an exact requirement of the customer. As per the customer's business model, 100 million is needed to be invested. But bank is giving only 50 million. Then the 50 million, he can't go my only more property also mortgage to this bank. The bank will not allow me to go for secondary mortgage. Now what to do? You will go to the money lender to get the money. You say somehow you have to start the business, and then so that you will go to a money lender, informal money lender, somebody, and get a loan, and then say, okay, I will give you 5% monthly interest to you. Go and get the money and then start the business and all that. Now 5% monthly interest to pay, like I mean, maybe you will have to pay 60% for a year. So that will drain out every cash flow, everything what he can get, and all that, and then he will fall into trouble. He won't be able to service the loan, bank loan also. He won't be able to service the money lenders thing, and then that will drag us into a problem. So that also is important. We are identifying what is the customer's exact requirement. Talking to the customer and doing at a lower scale is different, but identifying this is the requirement, but telling that only this much we will give also is risky, right? Clients, so difficulties we should understand, because client will always say, I have my stocks, I have my stocks, 200 million worth of stocks I have. Anytime you come and inspect and see. And you go and do a stock inspection and see, and then you do look at the age analysis of the stocks. If you say that, I mean, there are majority of the stocks more than 6 months is keeping, I mean, let's say any business, he is simply blocking his working capital with the stocks, right? If the stock is turning over, only holding high stock will be worthwhile. Otherwise, for his requirement, he must keep. So when he is going and putting into that kind of a thing, you know, unnecessarily stocking and thinking that, okay, during COVID period, the prices will go up and all that, it can work. It's a different matter. But it will push into cash flow difficulties, because when, like what I told you, with the unproductive investments, or for ego-based products with a car, house, and all that, which doesn't really contribute investments from the working capital, or going and you know, putting into the stocks and all that, which really will put the business into cash flow difficulties, right? Relationship, you know, breakdown. We need to know now. There are a lot of business with partnership days open. Like, I mean, in the business, in the limited liability companies also, there are directors, private limited liability companies, investor directors who are there. Now, unless we understand what is the relationship amongst them, is it cordial? Are they all in the same game, or are they fighting with each other? If you don't know regarding the relationship status, we may be in for a shock later, right? We may be in for a shock later. The other day I visited a customer. Customer is a agent of sole agent of a premium car brand. So he was doing really well in the market because the car is a premium brand. So that the import and selling of brand new cars, and then for servicing facilities and all that. Not only one brand, he had doing with about 2-3 brands. Now what happened? The customer is actually fell into trouble because cars cannot be imported. So he doesn't have new cars to sell, and he is only servicing all customers' cars. He's servicing, and cash flow dried up, unable to settle the loans, unable to settle in the working capital facilities he has taken, and loans are under moratorium. Kind of a lot of difficulties. Then I went and found out even looking at it, a branch also has gone and lent to a customer big amount. Why? Because it's a non-customer, it's a big customer, corporate customer also. You can go and lend it to them. And see, that shows that how do they they haven't done any analysis as a branch. They haven't done any analysis. When I looked at it and then okay, they are a good brand and all that. Okay, we can give that and all that given. So now when there's a problem. Now we are looking at unable to meet the owner. Some issues with the owner. Some problem with custom duty not properly paid, and all these things will come up only when the business has fallen. So relationship between the customers, stakeholders, as well as relationship with the bank also is important. Now let us say some customer under these conditions, not answering the phone, not not entertaining anybody visiting, and we are also angry. Let's say if we do that, what will happen is that it's an NPA, unrecoverable NPA it will become, right? So the maintaining kind of at any point of time with a customer, maintaining relationship also is an art. If you don't maintain cordial relationship with the customer may be fallen into trouble. Now we honestly will look at how to rehabilitate the customer. But if we just get angry and then useless fellow, no point, can't get or whatever, that unless there is a very good security, the bank is in trouble, right? The other one is the credit risk, which we discussed anyway, right? Which is the problems. So this is basically about, we briefly looked at areas of credit analysis and the risk, what are the risks you will be looking at, and what are the risk mitigation measures. When it comes to risk, of course, what are the 3 ways you will be handling the risk? You first identify the risk, and then either you can hedge the risk through insurance and all that, or else you avoid the risk, you don't take the risk, right? It's too much of a risk, we should not take the risk, so you avoid it, or else you have some ways of mitigating the risk, right? So many risk mitigation measures we looked at, and of course on the valuation. So how do you look at the market valuation? How do you look at the For-sale valuation, what are the general contents in a valuation report and all we looked at, right? Who can be valuer and all we look at subsequently. And we looked at, I mean, while you are doing the proposal, while you are doing a looking at a proposal, what are the things from a personal customer you will look at, what are the things from a corporate customer you will look at, and how do you understand the customer, what areas you will be looking at, you know, and then what are the problems you will come across if you don't really understand the client and you just go and do a name lending or just trusting the customer's word and go and do a lending. The problems that you will be faced with, all that we have discussed. All right, any questions? Any questions up to now? Are you clear on these areas, which are basically core part of your lending, right? Your credit management, the pricing part of it. All right, shall we go to the next section? Analysis of financial statements. Right now, as far as we are concerned, we bankers, we don't go and learn how will you prepare, how do you prepare the you know, accounts, how do you maintain, how do you do the bookkeeping, right? Then how do you extract your trial balance? How do you, from the trial balance, how do you do your profit and loss account and balance sheet? How do you, you know, develop your cash flow statements, right? So all these areas, you know, preparing the final set of accounts and everything is part of the job of the company and the auditors and the accountants, their accounts department, and then their auditors certifying, all that is their part. As far as bankers are concerned, we don't aspire to be experts in preparation of accounts, right? So that our area we are going to look at is not going to be of anything like, you know, how do you prepare, whether there's anything wrong in preparing, not that. All our concern is on the financial which are submitted for our analysis to do to arrive at a lending proposition, to arrive at a lending decision. Our perspective is that we will look at it and then see that whether this particular customer is capable of taking this loan, whether this loan is actually required, whether this customer can take the loan and pay the loan from the cash flow what he has. And our concern is that we will look at it and then for now how it is going to be for the next let's say next few years until the repayment of the loan, how it is going to be. We will analyze and see that whether the customer can meet his financial commitments on the cash flows what he's getting basically. So our concern is that. So our concern is that perusing and then getting the information what is required for us. So we are not going to look at how the accounts are going to be prepared. right? So what are the important financial statements? In a set of final accounts, what are the financial statements which are forming part of? So number one is that, as you know, the profit and loss account. We also call it income statement, right? It's a profit and loss account. So what is the profit or loss produced by the firm, by this company for a particular period of time, right? For a particular period of time. That's why we call it a period statement. Income statement, profit and loss account. It's a period statement. So it's for a period. It will say profit and loss account for the year ended 31st March 2021. That means this is for 1 year, commencing from 1st of April 2020 to 31st March 2021. So that is given for that particular period. Now your bank, how the accounts are prepared, income statements prepared for a period from Jan to December. So we will say income statement for the period ended for the 1 year period ended 31st December 2020. So income statements, we'll go a little bit into that. Those are basically prepared. What is the profit or loss generated by this particular business for the particular period? Then balance sheet is normally called a position statement. It's a position. It's not for a period. We don't say balance sheet for the year ended 31st March 2021. We will not say that. We will say balance sheet as at 31st March 2021. Why? Because those are the balances of assets, liabilities, equity, and all on a particular date, right? That may be different the previous day, that may be different the day after. It's only that is the position on that particular date. That's what we give. The position of the business on the particular date is this. On that day, these are the cash holding, this is the debtors, these are the creditors, these are the payable, receivable, these are the inventories, these are the profitability, retained profit is so much, this much is the borrowing from the banks, and this is what equity, all on a particular date. Cash flow statements, right? Cash flow statements are normally taken for a particular period. That's like the income statement, but the difference between these two statements is very, very significant, and you all should understand, right? Profit and loss account is prepared for a period, and that shows what is the book profit made. That means you will charge everything which you I mean on accrual basis. We call it accrual basis. This is an accrual basis thing. So what is to come there for the particular period, we will charge. For example, if you have a machinery, for machinery normally we depreciate over a period of 5 years. The cash has been paid 4 years back. Now we will keep on charging the P&L every year 1/5 of that, right? If it is like, I mean, our depreciation policy is to depreciate over a period of 5 years. Let us say we bought a machinery for 100 million. With 100 million, even though the cash has gone in a particular year, 100 million cash has gone, we will go and put to the P&L only 20 million, right? During the year of the purchase, 20 million only we will put. Balance 80 million will keep to be put to the P&L of the subsequent years. So that is actually not the cash. So that is accounting. That's accounting. So so the first year, of course, 100 million would have gone, but we will be charging to P&L only 20 million, right? So subsequent years we wouldn't have, there will not be any cash outflow with regard to that, but we will be charging the P&L with 20 million. So like that, the depreciation. Then let's say there are kind of things like, prepayments. Okay, now you go and pay the advances or the rental. Let us say rental we have paid in advance for the building, rental paid in advance this year, which is relevant for next year also. So this year, cash is gone out. We have paid the rent in advance, but we will be enjoying that next year, right? What happens is that then we will go and put our cash flow, of course, will be affected by the full amount what we pay, but what is relevant for next year, which is paid this year, will be to P&L only next year, right? Let's say for 2 years you have paid the advance. So the current year, of course, okay. Next year, that rental also paid this year, you will go and put that only next year. So like that, when it comes to profit and loss account shows on accrual basis it is prepared. It doesn't really reflect that how much of cash flow is there in the business, but it just shows that what expenses that should be booked for this year, what should not be booked, and then based on that, on accrual basis, it is given. So it's a book profit. So the book profit that is used for regulatory purposes, for paying taxes, for showing the viability of the business and all that. But as far as banks are concerned, we are not all that concerned about this profit and loss account and the shown profits and all that. We will be looking at basically whether they have, end of the day, sufficient cash flow to pay our loan, right? Sufficient cash flow to pay our loan. So from the profit and loss account, we will rework. We will go and rework. If we look at that and then see that, okay, from the profit and loss account, this is the profit, but how much actually cash gone out and cash come into the business? So we will rework on all three different areas, on kind of operational side, how much has cash gone in, how much has come in, on investing, how much has gone in, how much has come in, on financing, how much has gone and come in, actually how much is paid, how much has been received, cash, how much has flowed in, cash, how much has flowed out. And then end of the day, it will give how much is the net cash balance in the account. Whether it is negative or positive, or it will show. That is a good indicator for the bank to say that whether that is good enough for us to do the lending to them, whether they will be able to repay the loan from that. That's the whole purpose of this particular cash flow statement. So, but then we will look at the balance sheet, income statement, all that we will look at it to understand the viability of the business, right? So viability of the business and then strength of the business, all that you can see that from the balance sheet and income statement or profit and loss account. But whether they can pay, whether they have sufficient cash flow is something the cash flow statement will throw out some light to us. And in looking at the balance sheet and profit and loss account, when it's given a full set of accounts, not that everybody is an expert, they will look at it and then come out with the specific problems, specific strengths and weaknesses, opportunities and all that. Whether they will come out is a doubtful thing, because not that everybody is an expert and then not that everybody has that much of time. So due to that only, we look at the ratio analysis, which is very important for you as far as your credit appraisals are concerned, as well as far as your exam is concerned. You have a 40-mark question here on your looking at your income statement, balance sheet and cash flow statements, and then on your ability to do a ratio analysis and come out with your suggestions. Okay, so I probably feel that you will have another course also, some of the overlapping course also, or like, I mean, some of the courses you will be studying that, but then still for all, here also that is a most important question. In that question you will be answering these areas. So your performance in that question decides your pass or fail. Because other questions are like, I mean, 20-mark questions, 60 will be there, unless you do that, do extremely good. If you don't do this properly, you will have problem in getting through the exam also. Any questions up to now? Are you okay? All right up to now?
Okay, sir.
Yeah, no questions?
No.
Okay, normally we need to look at a trend analysis, in the sense how the trend of the business. So if somebody customer comes and gives you 1 year's annual report, his annual report is this, and then you find profit and loss balance sheet and cash flow and all that in this, and then you do that. I mean, it's difficult. So you need to look at the trend, how the business is performing for the past 3 years. So if you have 3-year financials, then you know that how goes up and comes down, and then what is the kind of a trend, right? How the profitability moves, how the assets are moving, how the cash position is moving, how are the other things like net profit, gross profit, and all is there, how the return on assets and return on investments and all that, how it is. I mean, you can look at a trend, right? Whether it is an increasing trend, whether it is stabilizing, or whether it is decreasing, and then you will look for answers. Why this is so, right? So that's called a trend analysis, which is a very important part of this process. And we from the customers ask for audited accounts, right? Audited accounts. So audited accounts, normally only chartered accountants are authorized to issue audit certificate, audit an account and set of accounts, and then give the audit certificate, chartered accountants. So that's why you find a lot of chartered accountant firms who are doing this. So chartered accountants. So when you are looking at a set of accounts, whether the accountant is qualified also. No, here it is different. Sorry about that. Now, when a customer, when an auditor gives a report, in that you find on before the financials, the auditor's report will be there in the set of accounts. In that audited, in the certificate, audit certificate, they will be expressing. They will say something, one thing very particularly. That is how they have carried out the audit, in their opinion, whether all the accounting policies as per the Sri Lankan accounting standards followed, and then whether it is in order, and then whether there is any exception. and they feel that there is a particular compelling issue, reason is there, it is not accounting policy not properly followed, then they can go and qualify themselves. That's what we call it, qualify. In that they qualify in the sense they say that this is not in line with the existing or the accounting policies followed by the company. It is not in line with that, right? So when they say that, it's a problem. They go and qualify the accounts, it's a problem, right? So we go and see that whether it is qualified, whether they have given any exception in the report like that. One example I can tell you, a tire manufacturing company some time back. Tire manufacturing company, their machinery, what they did was, they had a policy and then they were depreciating. Right? They were depreciating. They say for 5 years, over a period of 5 years, they were depreciating. And also the tire manufacturing company, the machinery set will be very expensive, like because it's a kind of a assembly line type of thing will be there in a tire manufacturing process. So I was looking at the financials. In the financials, the auditors were telling that the accounts reflect free and fair, reflect a fair view of the accounts, status of the company, except something. They said except something. Then it's qualified. Except what? They said, now this company is following a principle of, in line with the Inland Revenue Act also, they are depreciating the machinery over a period of 5 years. They were doing that for the last 2 years for a big machinery acquired. Now they say that the economic life of this particular asset is longer, not 5 years. It can be used for 10 years. So we are depreciating the asset not over 5 years up to now, like 1 year or 2 years we have done that, but for the balance period will be stretched up to 10 years. Then what happens is that the amount of depreciation charged to P&L will come down by that, right? Because what you will be depreciating over a period of 5 years, now you are talking about depreciating over a period of 10 years. Then if that happens, what will happen? Your profitability will be higher because your depreciation is lower. So it can be a kind of manipulation where you go and reduce your depreciation or change your policy and then increase your profitability, right? Increase your profitability. A similar thing happens when you are going and, let us say, showing, when your stock is high, in the book it is lower. Then your profit can be, you will show your profit lower. It's the other way around, right? When let us say your stocks prices are higher, but you show lower stocks, right? That means higher amount charged to the profit and loss account because you have shown lower additional stocks, means whatever procured during the year will get charged to the year to a larger portion. Then that will bring down your profitability. So this is how you manipulate the profit, right? Either increase the charge to your profit and loss account. If you increase your charges to a profit and loss account, you are reducing your profitability. Or reduce the charge to the profit and loss account, you increase your profitability. Like what I told you, a depreciation amount going to the profit and loss, when you reduce it, your profit goes up. When the stock amount, inventory, if you show a higher amount of inventory, that also can what happened? Should reduce your profitability. Right. So that's about qualified opinion or unqualified opinion, right? Opinion of an auditor should always be unqualified, right? It should be unqualified. And then you will look at the accounting policies, what is adopted, whether it is in line, and exceptions, what are the exceptions, and all that also will be there in the financial accounts. So you are taking a profit and loss account, income statement of profit and loss account. So what are the areas where you are looking at a profit and loss account, which is normally you have your business turnover, right? Your income statement will be different when it comes to a trading firm and then a manufacturing firm. A manufacturing firm will have an additional area where they will have, like, what is the trading profit? They'll identify the trading profit. And then their overheads you put, and then they come to the net profit, right? So they'll be charging the factory overheads separately from the factory overheads and contribution and all that. For the raw material and everything they charge, and then all that. And then they come to the particular trading profit, and then the overheads are charged after that. Office overheads are charged after that. So now a business turnover, how much is the cost of goods sold, and then you arrive at a gross profit, and then the operating expenses, sales and distribution, administrative expenses and overheads, you deduct. Then you get the other operating income. And then from that you reduce the finance cost, and you get the profit before tax, right? And your taxation and your profit after tax. The entire set of your balance sheet can be shown in this simple formula, right? In a business, the total amount of asset is financed by number one, the equity, and number two, the liabilities. That's all your balance sheet. Your balance sheet tells about this only. Your balance sheet says that what is the asset, or the total asset of the business. So assets can be classified in various areas, which can be fixed asset, which can be current asset, which can be tangible, which can be intangible, right? So various ways of categorizing assets. Which is how it is funded, right? How it is funded. So primary source of funding assets is equity, then the liabilities. Liabilities come from the long-term to short-term borrowing, right? That's about that's the balance sheet precisely about a company, right? Or even individual. That's the balance sheet. So if you put the other way, other side, if you take the liabilities to the other side, assets minus liability, that is the equity and that is the net worth, right? So that's, simply to put, that's all. If you normally be asked, is a high net worth customer, how do you say somebody is a high net worth customer? Is a high net worth customer because if you look at how much of assets he has, how much of loans he has to pay, then balance is so much. So that is high. That's what you are to mean by the word high net worth customer. It's not that somebody who has 100 billion assets and 105 billion liabilities. He's not a high net worth customer because his liabilities are higher than his assets, and he has a negative net worth. right? It's a negative net worth. We call it is a negative net worth. A negative net worth is only owing to the banks and financial institutions. He doesn't owe anything, own anything, right? Literally. So those simple concepts you must understand. What's a balance sheet? The balance sheet. That's all. As simple as that. Pages together, balance sheets are there, items are there. All that is only, the principle is this only. Like what I told you, cash flow statements are prepared in two different ways. So anyone who is giving a cash flow statement, you will find that, I mean, somebody will use this way or somebody will use the other way. So they normally, one way of doing that is that they look at how much is the cash at the beginning of the year. What is the cash at the beginning of the year, right? That's the exact cash in the business, right? So from that, they start calculating. From that, they say how much of cash received from the operations. So now those are, you know, the company's total operation is divided into three areas. One is operations, the other one is investing, the other one is financing. So operational activities, investing activities, financing activities. You divide into three, right? So you start with how much of balance cash at the beginning of the year. Take it. And then you say from the customers how much received, right? Customer would have paid for the purchases, customer debtors would have paid, right? All that will be how much of cash received from the customer, hard cash come in. Right? So you take it. And then from the cash, how much we have paid in the operations. You would have paid for inventory, administrative expenses, wages paid, interest paid, income tax paid, all are paid out. Right? Is not that accounted and then unpaid and kept in the account, but these are all actually cash paid out. So you put those things. So then you arrive at the net cash flow from operations. How much is the net cash flow from the operations from that? Then you look at the investment activities. So how much of cash received from selling the assets, property, equipment, you know, these are in business can happen. You know, you will sell an old asset, buy a new one, right? Buy a new car. Right. So investing activities. So sale of property or equipment, that will be a, you know, that's the inflow. That's an inflow, right? Cash paid for, you know, property, equipment, new properties bought, new equipments bought, new machinery bought, and all that. This is cash, right? So you take the inflow plus and then outflow minus, right? How much is outflow? Cash paid for, all minus. So net cash flow from investing activities is a minus. Net cash flow from operation is a plus, right? And then when you look at the cash, how much financing activities. In financing activities, of course, like what we fundraising, what we looked at, different ways of financing. So cash received from you know, issuance of equity stock. So cash came in. So we borrow from the bank, borrow from the you know, kind of intercompanies, you know, borrow from the market, whatever. So how much of money came in by way of borrowing, and how much money paid out, right? Okay, if treasury has redeemed treasury and all that time, you know, paid out, you know, paid out. Okay, so loan repayments, right? How much of money paid by way of loans. Then you look at, I mean, dividends also, if it is paid during the year, how much a dividend paid. So dividend paid out also is taken into account. So you look at the net cash flow from financing activities, how much. So you found from here that there is, from the operation, there is a positive cash flow, and from investing and financing activities, we have spent more, 41 million and then 87 million financing activities. These are cash outflows. So net cash, net increase in the cash is 19,500 during the year. During the year, net increase, it shows a net increase. 147,900 million, 41,400 million, minus, both are like 147 minus 41 minus 87. That's 19,500, 19.5 million. Added to the cash at the beginning of the year, you have a total of 35,200,000 at the end of the year. So this basically shows about the cash flow statement. So that the customer has this much of cash flow. So when you are looking at a particular proposal, and you will look at how much of loan he has to repay. This is one of the parameter. From there you will be satisfied with the cash flow that the customer is comfortable to pay the loan installment. The other way of doing cash flow is you start from your net income. Net income is P&L income. So net profit, you take the net profit. You take the net profit. From that, you keep on adjusting for the cash flow from operating, cash flow from investing, and cash flow from financing. When you are adjusting, you will add the, these are non-cash items, which are depreciation, amortization, and all that. These are non-cash items. Provision, non-cash item. Whatever amount gain on sale of facility, right, which is shown in the P&L, that has to go elsewhere, not here, right? That you will deduct it. And then increase in trade receivable, decrease in inventories, decrease in trade payables, and all that. That changes in those debtors, creditors, and inventories, how it will affect the cash flow. You go and do the adjustment. Then you look at the cash flow from the investing activities, right? How much is invested? Here you find purchase of property, okay, which actually doesn't come to the P&L. No. Purchasing of a property normally will be reflected in the balance sheet. When you are purchasing a property, what will happen is the balance sheet item is cash or bank will reduce and your asset will go up. Okay, so that in the balance sheet. But cash has gone out. So to the cash flow, it has gone out. So you will have to take into account. Proceeds from sale of equipment. Yes, you sold it, and you got the proceeds. So the proceeds is booked here, right? It's booked here because it's a cash inflow. Money has come that wouldn't have gone into the P&L. So you are booking it here. Then cash flow from financing activities. Proceeds from issuing common stock, that is equity, right? How much proceeds generated? You have proceeds from issuance of long-term debt. These are all inflows in your investing activities, financing. So, not investing, financing activities, you have got a long-term debt. So that comes. Dividends paid is outflow, right? Amount paid. So that you take into account. So in the similar way, you will find that the net increase in the cash and cash equivalents is how much. So at the beginning of the period, so much. Then cash at the end of the period, how much? So it's about $5 million at the end of the period. So this is how you will look at the cash flow normally prepared. From this, we will see that, how the cash flow is, and then what are the activities here, and then how end of the day, whether it is a negative or positive cash flow, whether it is sufficient enough to pay your loan, right? So this is about your cash flow statement. Then financial analysis, we'll have to go into the financial analysis. Okay, so we will start from this financial analysis at the next class, talking about this. Then we will look at how the financial analysis we are doing. Especially, we will concentrate on the ratio analysis in the next class, how to do that, right? Okay, any questions here? Are you all clear? Are you all clear on what we looked at, the basics of financial statements, on what we looked at, what do you understand by the profit and loss account, balance sheet, cash flow, how do you look at your balance sheet, how do you understand your balance sheet, how do you understand your cash flow statement, all this, because it's our job is as bankers understanding that. How do you understand? How do you derive? How do you take lending decisions based on that? Is where we have to attack, right? Okay. If you don't have any questions, please ask any questions if you have. If you don't have any questions, we will wrap it up for the day, and we'll meet up next Sunday, same time. So have a nice weekend. Enjoy your day. Enjoy your holiday coming. And holiday is only 14th, I suppose. Yes. Right. We'll meet up next week. And see that you all submit your assignments. All right. Bye.
Thank you, sir.
Thank you, sir. Bye.
Okay.
Thank you, sir.
Okay. Okay. Bye. Thank you.